got a view from what a large domestic fund house is thinking. But what about FIIs and what's going to happen to foreign inflows? Neil Mascarenhas, fund manager at Hammond Investment Group, joins us on this conversation. Neil, thank you so much indeed for joining us today. We've seen two important reforms getting stalled in Parliament. One, GST, the other is on land reforms. Are investors getting worried that this government is perhaps losing momentum?
No, I think that the reform momentum is intact. The government has already demonstrated its intention towards reform momentum. We'll just have to wait a little longer. What's more worrying is the paralysis we are seeing in Parliament, which for foreign investors is reminiscent of 2013. Politics is about consensus building. So I think it's very important the government gets its act together and involves everybody in the process.
Okay, so we've seen, Neil, about nearly $7 billion of FII money come into equity so far this year. So are you suggesting that you're going to see these levels of capital flows sustain, if not go up?
Definitely, you will find FII flows coming in, but what's more important is the FDI. FDI, which we expect in India. FDI numbers are only growing, and FDI is what's really required if we want to see some of the larger macroeconomic, if you want to see some macroeconomic stability and some of the larger issues resolved, not so much FII.
Okay. The other issue has been on stalled projects. There is some data now emanating that talks about how the stalled projects are now getting back on track. Are you seeing evidence of things moving on the ground?
I've heard that there are about 42 projects worth $18 billion which have been recently approved. From the Economic Survey 2014-2015, 585 private sector projects which have been delayed. I don't expect much to happen there. But on the 181 government sector projects, the government can do something to kickstart these. On the private side, the government has to come out with a new format on PPP projects, whereby they take some of the risk on themselves through some sort of a hybrid system, rather than what we have right now. That's the only way private sector investment and private sector projects will recover in India. And they can start with roads and highways. That would be the easiest.
Okay. Corporates here in India have been clamoring for cut in lending rates, cut in borrowing costs. How much is that a factor in spurring investments?
I think, Governor Rajan has made it very clear that he's focused on CPI inflation and exchange rate stability. I feel that given the near normal monsoon as well as falling oil prices, there is a chance for a rate cut in September. However, we have to also keep in mind the global viewpoint of US rate hikes. Governor Rajan seems to be preparing India for this and the volatility that will follow. He wants to have some buffer and monetary tools he can use. However, given the environment we are in right now, that's low credit offtake, low consumer demand, and flat order books, the government really has to do something to spur investments and restart these stalled projects. Yes, the government is being financially prudent, but if not its own balance sheet, then it should partner with FDI and offer them some sort of guaranteed return. This is the only way I believe these projects can come back.
Okay, so you're alluding to FDI and how that can help. This government has done quite a bit on opening up FDI. I mean, in sectors like insurance, defense, that have been on the anvil for a while. But are you seeing pickup on these sectors? Is smart money returning or long-term money returning to India? Is India becoming a choice destination?
Absolutely. India has always been a choice destination. Because of its captive market, its demographics, its low wages, among others. We just made it tough and a rough ride for most FDI. In 2014, we had $34 billion come in, which was the 9th largest globally. The year before that, it was 15th globally. Let's face it, India is dependent on FDI. Right now is a golden opportunity for India to be able to attract this foreign capital and solve some of our longer-term issues, such as trade deficits and the currency. Right. Let me give you an example of electronics. Last year, electronics was the 3rd largest import component after gold and oil at $45 billion. A Frost & Sullivan report says that by 2020, the electronics demand in India is expected to be $400 billion, and we have no capacities built up right now. So just imagine what this would do to something like your deficits and your currencies. What we need is FDI into domestic manufacturing in India, and not just FDI for export-related manufacturing.
Okay, I have one final question very quickly, Neil, and this is with respect to, again, FII flows. You know, one overhang has been this debate over minimum alternate tax, or MAT. The government has made the right noises saying that, look, you know, we're trying to do what's in the best interest prospectively and so on. But still the matter hangs in courts. How has this affected sentiment, particularly for guys who are investing in India?
You see, whatever outcome comes from the courts, at least there'll be clarity. The problem is these decisions were not taken, eventually recur, as with what we are seeing with P notes. Let me give you an example. In the fixed income market, the government was trying to attract foreign investment into infrastructure through foreign debt. After some discussion, the 20% withholding tax was brought down to 5%. And now with MAT, it's all back to square one. So we have to wait for the Justice AP Shah report, which has been given to the Finance Ministry last month. If they rule in favor of the FIIs, then the government needs to accept this report. They need to come out with a circular, and they need to table this to the Supreme Court. If not, and they keep this report, they don't make this report public, that will be the worst, I think.